Contract of insurance. Definition. The definition of contract of insurance is: contract of insurance is a contract of indemnity to indemnify a person against the losses on happening of an event, or pay him money on happening of a specified event for an agreed consideration. Here consideration is the premium. So insurance is nothing but when a person goes to insurance company and he pays premium for a certain happening of an event, the insurer will indemnify him, indemnify the losses. There is a case law for this. The case law is Prudential Assurance Limited versus Inland Revenue Commissioner. So in this case law, it was held that for a valid insurance, there should be three ingredients. Firstly, there should be uncertainty. The happening of the event should be uncertain. Both the parties should not know whether the event will happen or not happen. Secondly, the event must be advanced character to insured. So even the insured should not know whether the event will happen or not. Thirdly, the event should be accidental in nature. So this was held in the case Prudential Assurance Limited versus Inland Revenue Commissioner. So who is the indemnifier in contract of insurance? The indemnifier is the person who is giving the insurance. He is called as insurer, insurance company, or even underwriter. So who is the indemnity holder in this case? The person who is taking the insurance is indemnity holder. He is called as insured, assured, or policyholder. Essentials. The essentials of a contract of insurance are: according to Section 10 of the Indian Contract Act 1872, there should be an offer and acceptance. There should be an offer from the insured and an acceptance from the insurer. Both the parties should be competent to enter into a contract. The contract must have been entered via a free consent. There should be a lawful consideration. The consideration in contract of insurance is called premium. And the object should be legal. The object of insurance should be legal. Nature and scope. So what is the nature and scope of contract of insurance? Insurance is a contract. So it satisfies the Section 10 of the Indian Contract Act. So basically insurance is a contract. Insurance is a cooperative device. So there is a cooperation between insurer and the insured. So insurance is a cooperative device. The next is sharing of risk. So the risk is shared between insured and insurer. So when the event happens to insured, the insurer will promise to pay. So there is a sharing of risk. The next is value of risk. So for the risk that insurer is paying, insurer is sharing, the insured will pay some value for it, and it is called premium. Payment of contingency. So the insurer pays to the insured on happening of an event. So the payment is done on a contingency. Amount of payment. So the amount is paid only when the losses occurred. Large number of insured persons. So only when the large number of persons take the insurance policy, only then it is feasible, because the premium cost will be reduced if large number enter into it. The next nature is, insurance is a business and not charity. Insurance is done for profit, so it is not a charity. So contract is aleatory, so it is a gamble. Insurance is a kind of a gamble, because you are gambling on happening of an event. You pay premium on happening of an uncertain event. Only if that event happen, you will get your money. So if that event will not happen, you will not get your money. So it's basically a gamble. So these are the nature and scope of a contract of insurance. The next is classification of insurance. The contract of insurance is classified as life insurance, general insurance, and reinsurance. So what is a life insurance? In life insurance, the subject matter is life of human. So life insurance only deals with a life of a human. When the life of a human is at risk, only then it is called as life insurance. Animal lives are not covered into life insurance. They are covered into general insurance. So the subject matter in life insurance is life of human. So what is the need? To protect family from premature death and old age. So if the family is dependent on a person, and if a premature death happens, sudden death happens, then the whole family should be fed, right? So the insurance is done for that. And during old age, the income is reduced of a person, and if family is dependent on them, then it will be difficult for them to survive. So that's why they take life insurance. Insurance payment. The insurance is paid after death or expiry of certain time period. Personal insurance. Only in the case of personal insurance, the payment is done on accident. The next is general insurance. In general insurance, the subject matter is property insurance, liability insurance, and other insurance. So what is property insurance? In property insurance, fire and marine insurance are covered. The next is liability insurance. In liability insurance, motor insurance, theft insurance, fidelity insurance, and machine insurance are covered. So what happens in a liability insurance is you are about to pay to third party. So the insurer will promise to pay on behalf of you to a third party. So that is a liability insurance. Fidelity insurance is also same. You are liable to pay to a third party, and you take insurance for that, and the insurer will on your behalf pay to a third party. That is liability insurance. The next is reinsurance. So what is a reinsurance? Reinsurance is a kind of double insurance. So what does it mean? A person goes to an insurance company and takes an insurance, and the insurance company will pay money to them on happening of an event. What if the insurance company goes into loss? So the insurance company in turn takes an insurance from a different company. That is called reinsurance. So the insurance company takes a insurance from another company in case if the insurance company goes into loss. This is called reinsurance. It is a kind of double insurance. Types. The types of reinsurance are: it can be done on an aggregate limit, or it can be done on per occurrence. So what is aggregate limit? The insurance company can set a particular cash limit to the reinsurance company, that only if this much loss occurs you have to pay. The rest loss will be covered by insurance company itself. But on per occurrence, this is not the case. On a happening of an event, like for example, an earthquake took place, and there are a lot of persons who will want insurance, but the insurance company is in loss, and they have taken reinsurance. So if all the persons try to claim reinsurance from the company, then the reinsurance company budget will go off. So that's why on per occurrence there is a reinstatement on per occurrence. So what they do is, the reinsurance company will set a budget first. So only for one happening of the event they will give that much budget, and then they will release another budget for another event. That's how it will work on per occurrence. So that concludes contract of insurance. The next concept is history and growth of insurance or life insurance in India. So what is the history? History is from Indus Valley civilization taking care of dying persons and joint family. So the history of insurance in India can be traced back into Indus Valley civilization, where persons were taking care of dying person. So insurance is nothing but in a way taking care of another person. So during Indus Valley civilization, the people were taking care of dying persons and joint families. In Manu, Manav Dharma Shastra mentions about taking care. Term Yogakshema, joint family in Rig Veda 3000 years ago was mentioned. Buddha introduced burial system concept of mutual welfare life insurance, which is nothing but life insurance. In 1818, Oriental Life Insurance Company, a British firm in Kolkata, was established. And in 1870, Bombay Mutual Assurance Society Limited was started. So there are 5 stages of history and growth. This is the main answer. You have to write this. For history of insurance and history of life insurance, the answer is same. You have to write these 5 stages. So the first stage is period of mushroom growth. From the year 1900 to 1912, there is a period of mushroom growth. So in the period of mushroom growth, there was a Swadeshi movement. So what happened in the Swadeshi movement was Indians were boycotting British goods and they were depending more on Indian goods. They were trying to produce more Indian goods and buy it, and they totally tried to boycott of British goods. This is Swadeshi movement. During period of mushroom growth, there was Swadeshi movement, and in 1912, the Indian Life Insurance Company Act was framed. The next stage is period of struggle and steady growth. From the year 1913 to 1938, there was a period of struggle and steady growth. This period is in between two world wars, from between the first and second world war. The Swadeshi movement led to struggle in growth of business. So the government was compelled to protect the Indian businessmen. The government was forced to protect them. The Insurance Act 1938 was enacted as a result of that, and all the foreign offices in India were closed. The next period is period of stability and consolidation. From the year 1938 to 1950, there was a period of stability and consolidation. So what happened in this period was the India became free from foreign competition. So the Indian companies gained stability. And after Second World War, Swadeshi movement gained strength and stability. Many amendments to 1938 Act were framed, and 1950 was major amendment making insurance institution more useful to India and people. The next period was period of boom and nationalization. From the year 1950 to 1991, there was a period of boom and nationalization. So what happened in this was 5-year plan was initiated, and India from an agrarian society became an industrialized society. So the huge capital started to be collected in insurance hand, and government used this fund for public welfare. The Life Insurance Corporation Act 1956 was enacted in this period. Era of privatization from 1991 onwards. So Insurance Regulatory and Development Authority Act 1999 was framed in this era. The next question is IRDA, Insurance Regulatory and Development Authority Act 1999. So what is IRDA? The definition of IRDA is an supreme authority that authorizes insurance business in India. So all of the insurance companies are controlled by IRDA, Insurance Regulatory and Development Authority, and it is regulated by Insurance Regulatory and Development of Authority Act 1999. So composition, what does IRDA consist of? The IRDA consists of a chairman and not more than 5 full-time members and not more than 4 part-time members. Powers and functions of IRDA. So what are the powers and functions of IRDA? Regulation, development, promotion of insurance business in India. So they regulate, develop and promote insurance business in India. And to the applicant, to the person who is applying for insurance, a certificate of registration, renewal, modification, suspension and cancellation of registration is provided. A certificate of these are provided. Protect interest of policyholder. They try to protect the interest of policyholders. They specify qualification, code of conduct, practical training to agents. The code of conduct to surveyors and loss assessors is provided. They ensure efficiency of conduct of insurance business. They encourage or regulate relation between professional organization and insurance business. The IRDA levy charges. They call for info during inquiries. Say for example, they think that if an insurance company is doing some certain kind of malice, then they will call for information and documents. They will ask that company to produce certain documents. They have that power. And they have the control to regulate the terms and conditions of an insurance company. And they specify bookkeeping and accountancy. They will ask the insurance company to keep proper accounts and bookkeepings. They regulate maintenance and margin solvency. They try to solve the dispute between the insurer and insured. Administering tariff advisory committee. They set percentage premium income. Business in rural or social sector they try to establish, and they have other prescribed powers. Importance or role of IRDA. So what is the role or importance of IRDA? They ensure interest and fair treatment to policyholder. The policyholder should get fair treatment. They look after that. Development of insurance industry, growth of fund and economy. They promote or apply high standards of integrity or fair dealing. Clarity and accuracy to policyholders. The policyholder gets a total clarity of what they are getting insured of, what is the premium, etc. It is the role of IRDA to look after. Speedy trials and dispute. In case of dispute between insured and insurer, they try to solve that matters speedily. Initiate new standards if needed, and promote self-regulation. IRDA 1999 salient features. What are the salient features of this act? So section 5 says that the chairperson office is of 5 years and other members office is also of 5 years. Section 6 states that removal from office, when this person can be removed from office, if they turn insolvent, if they are mentally unable to continue, if they committed an offense, if they try to jeopardize their position, or they not use position in public interest, then they can be removed. Section 9 says that administrative powers of chairperson, the general superintendence and direction are his powers. Section 13 states transfer of assets liabilities from interim IRDA to authority. Section 16 states that constitution of funds. So IRDA tries to collect fund. So why they collect fund to pay salaries to the chairperson and other members of IRDA. The fund is collected by government and the fund is also collected from the premiums. Section 17 says that accounts and audits. The accounts and audit, the way it should be maintained is said in section 17. Section 18 says about central government can issue directions to IRDA. Section 19 says that central government can intervene at any time. Section 20 says that the IRDA should furnish returns to central government. Section 22 says that protection of action taken in good faith. If IRDA takes certain action in good faith, then they have complete protection against the suit regarding it. Section 24 says that power to make rules. IRDA has total power to make rules. That's all.